All right, guys. So today I'm going to show you guys how to analyze the historical performance of a stock. Okay. So I'm going to choose Apple. So let's go to, for example, here, Yahoo Finance, and let's search Apple. And we know Apple's ticker is AAPL. Okay. So once we search Apple, we go to the historical price or historical data. Okay. So here you can download the opening and then closing price and the volume of the stock. Here is Apple, right? At a daily, weekly, or monthly frequency. Okay. So here, of course, you can download that for 1 year. By default, it's 1 year. You want to click on Max to download all the historical data. So this is from 1980, December, when the stock was first listed. Okay. So we want to do daily, and also we want to do monthly. So first, we're going to do daily, and you click Apply. Okay. Now the data is going to be daily. So just check whether here is daily. Once you check it's daily, now click download. Okay, so now it's download right here. So then we are going to change this to a monthly frequency. I will do only monthly and daily to get the point across. Of course, you can use the same model. You can build the same model in Excel to analyze the weekly as well, right? But the point is you understand that why day trading is not a good idea, okay, unless you have a large account like a $1 million and you efficiently do the scalping with the radar and a team help you to identify what is a hot picks. Okay, otherwise monthly trading or 2-month or quarterly trading is the best thing. Okay, but for different kind of stocks you will have different strategy. The analysis though is always the same. Okay, so here you see that it's still the daily data. So I want to click on the apply. So now you see that this is actually the monthly data. And also this records 4-to-1 stock split and stuff like that, right? So you don't need to worry about this because these prices are automatically adjusted. And when you download the data, of course, this is the CSV file, you will not have these rows, these announcements. You will only have these price, and these prices are already adjusted across the board. Okay, so now I'm going to click on download. Okay, now I have 4 and 5. So now I'm going to open this file, and don't worry, guys, I'm going to switch to Excel. Okay, one moment. So now I'm going to switch to Excel. We're going to start working with stuff in Excel. Okay, cool. So first in Excel, you got to understand this is a CSV. So you want to convert this file format into, so you want to save as, okay? You want to save this as a, of course, for example, to the desktop. You don't need to see my screen, okay? So I'm just want you guys to understand, you need to convert this to Excel workbook before you start working on it, okay? So I'm gonna change the name to Apple stock analysis. Okay, so once I save it, you will be able to see the name change. Okay, so now this name changed, and now this is the Excel file. Okay, so now I'm gonna go back to Chrome. You will still be seeing my Excel. I'm gonna open up the monthly data as well, and now I'm gonna do a copy and paste. Pretty soon you will see this sheet going back to where we have right now. Okay, so just one moment. So I made a copy to what do we have here, the Apple stock analysis. Okay, so I'm going to enlarge the screen a little bit so that we can work with it a little bit better. And I'm going to zoom in so you see the data a little bit better. And I'm going to name this one monthly return. Okay, because this is monthly. And I'm going to name this sheet daily return. Okay, so of course, let me zoom in. So here, let's do the daily analysis first. Okay, so some of you probably familiar with the function in Excel. It's called pivot table. Okay, so before I do pivot table, here's the idea. Okay, I want you to write this down. So the idea is I want to find out the average daily return. Okay, and then in this case, when there is monthly return, I want to find out the average monthly return. In this case, we have 12 calendar months, right? I want to find out the average return for each month. And also, I want to find out the risk. What I mean, the standard deviation of the average returns of each calendar month from 1980 to 2020, right? So that gave us 40 years of data. This is really a lot of data, right? So once I do that, I will have a clear picture whether put my money down to buy, let's say 100 shares, 200 shares of Apple, and just put it there for 5 or 10 years, how much would I make versus that I get in and out of the stocks based on the historical return and the seasonality, right? Seasonality, right? That which one I can make more potentially, or the question would be, is there an opportunity for me to do so? Okay. So first of all, let's go to the daily return. Okay. So the daily return, what I want to do is I want to create a few more variables. So year, month, okay? And of course, I want to calculate the return as well. The return is very simple. It's going to be the closing price minus the beginning price, right? That's the open price divided by the open price, okay? So this assume you are doing day trading. You are doing day trading, okay? Because this is daily data. So you buy at the open, sell at the close, okay? So this is how much you would get. And the year, simply we use year of the date, which is A2. And the month, we use the function called month of A2, okay? So now I have all this. I can simply double click and automatically it's calculated for the rest of the table. So I don't even need to drag down, okay? And another thing you can do is go to data and then click on the filter. So now you have automatically this filter. And if you click on this arrow down, you will see that we have 1980 to 2020, right? And in return, you will see that we have all these. You see the maximum loss you can have on the 1 day is 24.35%. That's 1 day. Okay, that's 1 day. And you guys probably will know which day is that, right? Because we have the dot-com bubble crash. Okay, so let's scroll down. Let's see what's the maximum. The maximum, oh, so there's some values not available, then we should have removed that, right? So the maximum here that we actually have a value calculated is 19.27. So 1 day, the maximum return you can have by getting in and out of Apple within a day, trading day, is 19.27, right? So it's pretty large. But it doesn't matter you will get this all the time, because most likely the average, what you can get, you see that here, right? Negative less than 1%, and you have positive is less than 1%, right? So it's pretty much very, very small, okay? So to make this, we are not going to scroll down to look at the data. What are we going to do is we actually going to lock. This is just for view. Go to view and then lock the top row. And I also am going to make the label have a different color. Okay, so I know this is a label. I can also format them a little bit so that it looks better. Okay, so now I have this, and I want to do a pivot table, and then to go insert pivot table. And of course, by default, so this is going to automatically select the active range. And even if you add more variables, you can change the range later. But the purpose of this is you're going to ask Excel to analyze the data instead of you yourself doing it. Okay. So before, let's think about it. It's either positive or negative or zero, right? So the return. So we want to add another variable. It's called the sign. Okay. So the sign, we're going to use if. So if this return in J2 is less than 0, we call it negative, because it means that the day trading will result in a negative return. Okay. If J2 equals 0, then we're going to call it flat. Okay, it means that you didn't make any money or lose any money. Otherwise, it's going to be positive, because there's only negative, flat, or positive. Doesn't make sense. Okay, so now I have the sign, and this is very important, right? So I do double click, and if you want to check, you can just scroll down here. Okay, if you're a little bit insecure. Okay, I'm just joking. You see that it's automatically populated for the rest of the table. So now we go back up, and you see, hey, I just create a new variable. Just understand, you don't need to create all the new variables at the same time. So as you progress, because guys, you can create as many variables as you want, because these are the original variables from the raw data from Yahoo Finance, right? But you can massage, you can play with this data as much as you want. So these additional variables you create, and then as you do more analysis, sometimes you want to create more variables, and that's totally fine, right? So you can just keep creating them. And if you want to do the filter on all the variables because you just create a new one, you simply go to data and then click the filter icon again, and then click it again. Now the new variables has this. So now let's do this analysis to go to pivot table and insert pivot table. And of course, by default, you're going to get a new worksheet. Okay, so a new worksheet here. Let me zoom in. Okay, and I'm gonna name this. Make sure you name every new worksheet that is generated or you create or created by yourself, right? So this one I'm gonna call daily return analysis, or I'm gonna call analysis daily return. Okay, all right. So first, what I'm gonna do is I put the sign right here. Okay, so this gave me a sign, and I'm gonna take out the trading days that doesn't have a value because it's valid to get that out of my calculation, and also no blank. Okay, so I want to calculate return. So let me drag the return down here. Okay, so of course this is the count, right? So this is the count. And if I do a right click, I can go to summarize value by and then choose average. And of course, there are so many more options right here. So if I click on more options, you see that you can give it the max, minimum, product, count number, standard deviation, right? A lot of other stuff. But for the time being, what are we going to do is we're going to summarize it by average. Okay, average. You guys see that? So let's make this a percentage so that it's easier for us to understand. Okay. So what does this tell us, guys, without creating a graph right now? Okay, this tells us on average, if there's a negative trading day for the past 4 years, your average negative return is minus 1.72, and a positive return is positive 1.78. It's almost the same. It's almost the same, guys. It's almost the same. Okay, does that make sense? Right? So let's actually do this again. Let's copy this table, right? Let's copy this table, and then let's copy and then paste. So we have another table, and this time I'm gonna do account, right? Go back to account here, and then let me change that into a number. You see that, guys? Number. Okay. So we have. Let me remove the decimals. We had 10,060 trading days for Apple stock since December 1980. Okay, out of that, what is the percentage, guys? Let's do a percentage. Okay, percentage. So what I call the probability. So this is going to be flat, negative, positive. So let's do that. Actually, let me move it right here. So there's going to be some space in between. And I'm just doing data analysis to prove a point here. When we do the monthly analysis, it's going to be much, much more interesting. Okay, so stay tuned and focus. Okay, I know there's a lot of information, so please take notes. And if you have any questions, type in the chat room. Okay, I'll review them later, and we'll talk about them after I finish the recording. So what is a percentage? The flat is going to be 725 divided by 10,000. So that gives us about 7.2% of the time. Okay, and the negative is going to be what? Is going to be the negative number divided by the total. Okay, you guys see that? So that is 47% of the time. And I can even change this. Look at it here. I'm going to make this dynamic. Okay, so just take in the information as much as you want. So instead of me texting, instead of me using the existing input, I'm going to change the flat to the input right here to make this dynamic. Okay, then now I just need to drag it down, and it automatically calculates for the rest. So 45% of the time, it's positive return. And the average is how much? The average is 1.78. And 47% of the time, it's negative, and the average is 1.72. And 7.2% of the time, it's a 0. So if you do day trading, what is the chance of you lose money? The chance of you losing money is what? 47%, right? The chance of you making money is only 45%. Flat means you don't win or you don't lose. So if you do day trading consistently, it will not work. How many of you got this idea now? It will not work. This is why day trading will not work. Okay, if you have large amount, this is what we call distribution. So you got to look at the number and understand, right? But why some day traders make a lot of money is because they have a huge amount of money, and then they are trading on specific stocks. They have a specific formula to scan the stocks, right? They have an algorithm to build in to scan the hot picks, and there are specific patterns they can trade. right? And that, of course, we're not going to cover today, but just understand that. But if you are just a retail trader, you don't have those professional tools, you don't understand that, and you're just trading by your emotion, if you think day trading is going to make a lot of money, no, because the number will tell you most likely you will lose money 47.5% of the time, okay? And then the negative average and the positive average is the same. And here's the thing. Why is the positive average return slightly higher than the negative? Well, because, in general, stock market is going up, right? Apple stocks, not just Apple stock price, but, majority of the companies that have very good business model have proven that they have a very sustainable and mature business model, are constantly making profit. The stock price, even there's correction, bear market, or financial crisis, in a general, the market is going up always. So this goes back to the idea, right? If you don't know how to trade, if you don't want to spend time, become a professional, if you just want to sometimes trade this like you're playing games, you might as well just become an investor like Warren Buffett, because you can simply buy S&P 500, right? And also buy some ETFs for the tech sector. If you like the tech sector, you think the tech sector has a lot of momentum for the next few years, and simply just enjoy it without you doing anything, without you checking the market, right? So this simple analysis, of course, I can make some fancy chart, right? But I want to focus on the monthly return, because that's the idea I would ask you guys to practice, right? If you feel good about that, okay? Because that's the thing, really, most of us, if you're not a professional, if you have a job, if this is not your passion, if you don't want to you spend a lot of time on learning to become a professional, you don't have the resources, then you can do what I call the seasonal investing, right? So seasonal investing, like most professional traders, they have a window from 20 days to 60 days. So they don't plan to go into the stock and come out and winning 20% today, okay? But they have a portfolio forward looking by analyzing the earnings forecast, okay? That you can write down, earning forecast, and also the earnings per share history. And to identify if a company has consistently been beating the analyst forecast on EPS, that stock price most likely is gonna rise, okay? So that's the idea. But the things when you compare this, you are comparing the stock's performance with its peers in the same sector. Okay, so you're not comparing that with all the rest of the stocks on the market. For example, Apple, you got to compare that with its direct competitors in the sector. For example, like Amazon or Google, right? Like Samsung, these companies. But the point is, daily trading will not work for most guys. Okay, that's why there's a 90-90 rules. 90% of the day traders, retail traders, lose 90% of their money within 90 days. Okay, all right. So this analysis you can do by yourself. Now let's focus on the meat of today's analysis, which you guys are gonna see a lot of good things, which is the monthly return. Okay, so for the monthly return, we're gonna do the same here. Okay, so this is the same, but it's just like records if you buy at the beginning of the month and if you sell at the end of the month, and how much return you're going to make, right? So let's calculate that. So the return of this monthly data is going to be the closing price minus the beginning price and divided by the beginning price or the open price, okay? So let's make this a percentage. And then let's double click. You see that right here, right here. You see the big difference right here. So this would give you, if you're trading on a monthly basis, you are seeing 2-digit return. Let's go back to the daily return right here. If you're trading on a daily basis, you see that the number is close to 0, because the analysis we have done and proven that the average return of the daily on daily basis, right? When it's negative is negative 1.72 and it's positive is positive 1.78, right? But what about the monthly return? So Apple is selling consumer product, hardware and software, right? So when you do consumer products, right, there's one pattern that is universal, and this is called seasonality. Seasonality. What does it mean? It means that usually, guys, which quarter, you can type in the chat room, which quarter would the company have the highest sales or the highest profit, quarterly profit recorded, right? It would be the last quarter, right? The last quarter. It might not be the last quarter of the fiscal year, but it would be the last quarter of a calendar year, because that's when the holiday seasons are here. right? Like people spend most of their monies in November, December, and January, okay? So now let's do the year and month like before. So year is gonna be year of A2, and the month is going to be the month of A2, okay? And let's also do a sign right here, okay? And I'm gonna do additional analysis right here. So sign, let's do if the return H2 is greater than 0, we call it positive. And if H2 equals 0, we call it flat. Otherwise, it's a negative return, okay? Right here. Okay, so we know that this year, so if we, let's do double click first, okay? And let's just sort the data by clicking on the data icon. And let's make sure you color code the original data right here in blue. And then you make this yellow, okay? So you know this is the variables you corrected. So the sign is right here, positive, negative, and then the flat. So if you click on it, you have flat, negative, positive. So this monthly, this is the monthly return data. So there's no error. So it's perfect for us to work with. But think about this, right? For year, we have 80, 90, and the first year, 10 years of the 21st century, and then the last decade, right? Obviously, we know that if we are talking about every 10 years, every decade, the characteristics of the decade is not the same, right? So it's different amongst the different decades. So we want to analyze data in terms of, so when we do the average stuff, we don't just want to say, hey, what's the average of the past 40 years? How about the average of every 10 years? And how about, let's say there's a recession, right? Or how about there's election years? So can we create a table for election years, by the way, okay? So what I mean, for example, let's do the decades first, okay, decades. So let's say if the year is less than 1990, we call it 80s, okay? And if the year is less than 2000, we call it 90s, okay? And if the year is less than 2010, we call it the 10s, okay? And the last one is called the 20s, okay? That's it. So let's close it. So this gives us a decade. And we can also create another variable. It's called election, all right? Election year. Does the election year sometimes have an effect on the stock price? Yes or no, guys? Of course, right? So, and also the recession, we can create a recession as well. So for recession, we can get the data from Wikipedia or Yahoo Finance, and it will tell you the list of recession years, right? To simplify the process, I'm just going to show you the election, how to do a VLOOKUP, and you can do this recession by applying the same principle, okay? All right, so you got to do something by yourself, right? I want to give you guys opportunity to practice on your own, okay? So let's create a table to do the election year so that we can do a VLOOKUP. You want to create a separate sheet here, and once you create this separate sheet for the election year and the recession year, you can use it to analyze anything, any ETFs and stocks and portfolio that you want, okay? So we call this references. So references here, we know that this is the year, and let's say this is the election, okay? So we know this year's the election, okay? So every 4 years. So the previous one is going to be 2016. So once you have this last two, you can simply choose to do this. You guys see that? All the way back to 1908. And that's it, okay? So make sure you drag from bottom up. So this you get to 1908. And the earliest stock market data we can get, actually, I can get from the CRISP database is the 1926. So this is more than sufficient to do that. So election, let's put it on election right here, because all these years are election. Okay, election, right? So it's all election. So now what I'm gonna do is I'm gonna go to the monthly return and then do a VLOOKUP. Okay, so I'm gonna look up the year right here, and I'm gonna go to the reference table and look in this range. okay, and press F4. And in this range, if the match is this year, I want to return to the second column. I wanted to return election, so I know it's election, okay? And then I want to type false to do exact match. So you can see that this election year here. But once I click down here, if it's not election year, you will give me all these error terms, okay? So to make this prettier, I'm gonna do an if error formula, wrap it around. And if it's error, we would say no, okay? Means it's not election year. All right? So once we do this, guys, we're almost done with the raw data analysis, okay? So let's go to data and click on this filter and then click on that again. So now we have election, yes or no. Decades, we have 4 decades, guys. So we're ready to do the analysis now. So let's, again, select all the table, go to insert and go to pivot table and create a new one and make sure that you name this new one right here as analysis monthly return. Okay, so now this is what's gonna get really interesting. Okay, it's gonna open your eyes. Okay, so focus. I drag the month. So now I have from January to December. Okay, let me zoom in a little bit more. Okay, so now let's calculate the return. Okay, so again, this is the sum, right? So let's do right click and then do average. And then again, what do we want to do is change this to percentage with 2 decimals. Okay, guys, so I know some of you probably looking at these numbers trying to figure out, oh, okay, there's positive, negative, like, but what do I see? Like, why does it matter? Okay, so what I'm gonna do is very simple. Okay, right here, I'm going to create a chart because chart is much easier for us to visualize stuff. Okay, and also I'm going to choose the chart type. One moment, guys. Choose a chart type that is easy to see. No, this one actually looks ugly. This one looks better. Okay, so let's also add the data label right here. All right, so let's also remember whenever you create a table, what do? You want to name, you want to do the label, okay? So Apple, okay, monthly return analysis, okay? Okay, so now do we see a pattern, guys? Yes or no? You can type in the chat room. Do we see a pattern? Is it the same for every calendar month when you get in and out of the stock here in Apple? Is it the same? There you go. So this is what we call very powerful analysis now. You realize that. So when you do day trading, you're almost making no money, and most of the time you're gonna lose, right? So that's why when you go to casinos, although casinos just have that 1 to 2%, 3%, 5% edge, but the more people betting, the more, in general, the casino will consistently make that 3 to 5%. So here, this is very interesting, right? So when we see this, we know that in September, the average return is negative, right? And in June, the average return is also negative, right? But for other month, we know that October is usually shot up, right? So this is, if you can go back and verify, if you've been watching stock price, you will know this is actually true, right? But the things we know that this is, so if you say, okay, now what do? Let's get into Apple, by the end of September, and then just hold it until like May, and then sell it at the end of the May, and then wait until the end of June, and then buy it again and sell it at the end of August. No, okay. But this gives you an idea that when would probably be a good time for you to get in, right? But now we just know the average return that tells us a lot about this animal, what we call Apple stock, right? The historical performance by month. But we still need to know the probability, okay? The probability is very, very, very important, okay? Understand the probability is very important. So now I'm gonna do another pivot table to show you guys the risk, what I call the standard deviation. I simply copy and paste, right? but now I'm going to do a standard deviation. So you see that this is the same calendar month analysis, right? It's still Apple, right? And this chart, by the way, I'm creating this chart right here, but you can actually move this chart to a new sheet. So you only see the chart, not see analysis. But what is beautiful about this chart, guys? Let me show you guys right now, okay? So remember that we have done the decades, right? Oh, actually, let me go back to this table, because this table is where we linked to this this chart, dynamic chart. So we go back to this table. I'm going to put a decades in the filter, okay, right here. I'm also going to put an election at the filter right here. Okay, you guys see that? Now I have 2 filters. So what I'm going to do is, let's say, because decades, we know that we have 1990s, 1980s, and then the first 10 years of the 21st century and the past decade. So what if I want to look at the average return pattern for the past 20 years? Because 80s and 90s is a little bit too far away, okay? Doesn't make sense. So what I want to do is I want to unclick 80 and the 90s. So now this chart shows me what? Only the average monthly return of Apple stock return for the past 20 years. Do you guys see the change? Yes or no, guys? You notice that the chart changed, okay? So the chart change now shows us it's pretty much the same, but what we see right here, December, is for the past 20 years, December, usually there is a what? There is a correction, okay? I should not say correction because, technically in the financial field, when you say correction, it means that it's more than 10% down, okay? Put 10% negative return. So I shall say that in December, there's gonna be a sell-off, okay? And also in September, so this number is smaller now, but still, it's quite consistent. Even just for past 20 years, we know September is a month that Apple stock usually drop, right? And then October, you have a reverse. That's very, very high, okay? And so now let's go back to the second one, okay? And I also add election right here. So I understand this chart is tied to this one. It's totally dynamic. Okay, let me show you guys. So if I want to analyze the past 10 years, I unclick the 10. So this is from 2010 to 2020. So guys, you see that for the past 10 years, again, it changed, right? But still, the pattern is what we similar to we saw for the past 40 years. So October and the first quarter. So if you do monthly trading, right? If you just get in, get out within the month, you will see this kind of pattern. But what if we do quarter? What if, like professional traders, we do 20 to 60 days? We're probably 20 to 90 days, right? Let's do 1 to 3 months, right? I know that even for the past 10 years, if I just buy the stock by the end of December, okay, by the end of December, and then hold them for the first 5 months, okay, well, hold it for the first 6 months, then my return is most likely going to be positive. How many of you see that? And then I'm going to have a bigger return than just getting to Apple randomly. Because if you get in at a high and the next month it drops, right, then you will have some loss. Of course, if you hold longer, it will go back up because, in general, the stock price will keep climbing, right? Because Apple is getting bigger and bigger and the profit is also getting bigger and bigger. And now this new 5G cycle comes out. A lot of them will get updated, even if not this year, next year, a lot of people will actually convert to 5G when the network is more mature, okay? So, I mean, I got my 5G new phone. The speed just really sucks, okay? There are only certain spot you go out and the 5G is good, but most likely you still have the 4G LTE speed, okay? But I know the network is going to get better, right? So most people just want to wait for a year, which is actually a very good strategy. So you know that even iPhone sales drop, just as Apple recently reported, right? You can say it's because of this special situation this year. It's also because, the 5G, people are not sure about the 5G, but we know next year, right? More and more people will adapt to the technology. So the 5G super cycle will happen, okay? But anyways, so this chart will give you an idea. And then let's go back to talk about the risk. And again, before we do this, again, I'm just talking about this as I think about the stuff we can do, right? And you can also think about stuff you can do. How many things can you do now? You see what I've demonstrated, right? With just what we have demonstrated. I have demonstrated about 50% of what you can do, what I'm going to show you can do, right? How many of you have already thought about additional things you can do with this, with what you just learned. Additional analysis you can do, right? So now you can write down ideas, what you can do with this type of analysis. So now let's go back. Let's choose all the decades right here. And let's select election year. So I want to show election. So you see that this is election year. So when election year happens, you see the return? So this is only election years for the past 40 years, okay? So there's only 10 years of data. On election year, still September drops, and then October drops, and then November and then December comes up. Why? Because when election, there's gonna be what? Potential risk of policy change. Yes or no, guys? So when there is potential policy change with the quarter earnings release, so you will have a higher negative return in September. And then you remember, if it's not election year, let me do this. Let me click on no. When it's not election year, you see that, guys? When we exclude the election year, we know October is usually positive, but October, when there's no election year, October actually has 8.82% on average that month. You guys see that? So I haven't included the recession yet, because that I'm gonna leave you guys to do it, okay? So what you wanna do is you want to go to Google and search a list of recession years since the beginning of the 20th century, the 19th century, right? I'm 20th century. So when you search that, you create a similar table, year here, and you write down recession, okay? And then you go back to monthly return, and you do a VLOOKUP just like this, and you're gonna have a year, and you tell, and you can see the recession or no recession, okay? I have done this on my own, but I'm gonna leave this one task for you guys to do it, okay? If you're really interested in doing this. So then you will have a choice here to add another filter, just like this, recession or no recession, and you will have more perspective. So think about this. If you incorporate recession, if you incorporate election, you incorporate decades, and you can also incorporate some exogenous shock. The more factors you put in, the more charts you can generate and compare, the more you will be familiar with the pattern of this animal. Yes or no, guys? The more knowledge you would have about the seasonality, right? So that's what I'm talking about. So now you're not emotionally blindly trading anymore. You actually know the behaviors, the history of this animal, right? So you know in October, usually this animal will wake up, right? So that's good for you to do some trading, right? And then it's let's say very safe. What I mean is that its probability is high if you buy in at the end of September and you hold this for October and then November, you will make money. Make money means you will have positive return, right? The likelihood is very, very high. So now I'm going to show you guys, right? So let's go to select all. So you have this is all the 40 years data with election year included and with recession years included. Okay. So this I'm going to turn this into standard deviation because we just talked about the average return. Then how about the standard deviation, which is risk. So I click on more option and then go to standard deviation and click OK. So this gives me a standard deviation. You guys see that? Okay. So this is the standard deviation. And let me create a similar chart here. Okay. Again, go to insert and then go to this chart and you want to use the same type. So if you like 3D, just make sure you use 3D for both because this way you have an easy way to compare. So let's put it right here down here. Okay, and let me change the chart type so that it's the same right here. I think it's this one. Okay, so let's call it. Let me enlarge the screen a little bit so you can see better. One moment. Okay, let me zoom out. Perfect. So we call this Apple monthly return volatility. Okay, analysis. Okay, so what does this mean? Okay, I'm going to talk about the concept of normal distribution here. How many of you actually familiar with a normal distribution? The percentage. Okay, so what it means let's say there's the average, okay? So let me add the data label right here, okay? So we know. So let me ask you guys this question, okay? You can type in the chat room. Which month has the highest risk, highest volatility? Which calendar month has the highest? Just by looking at this chart. There you go, January, right on. Which month has the lowest? February, right? But again, what does this mean, guys? What does this mean, okay? So write this number down, 65%. Write this number down first, 65%, okay? And another number, 95%, 95%, okay? So what does this mean? We have the average return right here, okay? 3.72 in January, right? You see that right here, 3.72. And we have a standard deviation of the return as 16.24. What does it mean? It means that 65% of the time, if you buy at the beginning, I repeat, 65% of time, if you buy at the beginning of January and sell at the end of January, you are going to have a return between negative 13% roughly to positive 20%. Okay, so you can comprehend this a little bit later, but let me just repeat that. You have so because we are talking about trading, what we are talking about calculated risk, right? So you have essentially 65% chance of making a return that is between negative 13%, actually about 12%, close to 13%, to positive 20%. Okay, because that's the probability distribution. Okay, so let's look at another examples. September, actually October. So October is 6.53 with the standard deviation of 15.58, which means that you have 60% chance to have a monthly stock return in Apple if you trade this stock. You get in at the beginning of October, and you get out at the end of October. It's between negative 9% and then positive 22%, right? So your average return is shifted. So most likely you're going to have a positive return. How many of you get the idea now? So you can create a chart on this, but you just need to look at these two numbers, and then you will know when is a good time to get in. And again, right, like I said, this has different thing, right? So you can select, hey, because for example, if this year is election year, you want to select only election, and then also here you want to select only election. One moment, election. Then it will show you this chart. So you see that election, guys. Can you guys see the difference? If it's the election year in September, the average return is about negative 10%, all right, negative 10%. And you will see similar pattern actually this year if you look at September and October's Apple stock return, okay? And then the standard deviation, you see the risk, is 21 point, almost 22% in September, 22%. It means that you have a chance, you have 65% chance of making a negative 30%, between negative 30% and 12% return. So how many of you want to buy Apple stock at the beginning of September and sell it at the end of September? Okay, so even if you don't know, right? So this is the thing, even if you don't know, then you know this is the historical performance of this animal, okay? So now you love Apple, you love iPhone, you love MacBook, it's a great investment. There's nobody gonna argue with you. Apple stock is a great investment. What I mean is you hold it for 1 to 5 to 10 years. It's gonna make you a lot of money. It has dividend as well. But if you want to, you can have a long-term portfolio for your financial freedom, right? At the same time, if you have extra cash laying around, if you want to do trading, then you got to look at these charts so that you understand how the market moves. When I say how the market moves, you can analyze S&P 500 index, because what we just did here, just for this one single analysis, right? I'm going to do another one, but let me conclude and let me summarize what we have done so far, okay? So what we have done so far is we are trying to understand the historical performance and the behavior of a specific animal. In this case, it's one stock, and this stock is a mega cap stock. Understand that, right? Because on the market, there's large cap, mega cap, there's mid cap, there's a small cap, there's micro cap. Okay, so for the mega cap stock like Apple, you have very low volatility compared to those teeny tiny stocks, okay? Those micro and the small cap stocks. But at the same time, you still have volatility, you have risk involved with these stocks. So if you want to make more money by trading what I call seasonal investing, right? Seasonal trading, right? By holding the stock at least for 20 days, right? 20 to 60 days, and you can extend that into the gray area, 90 days, but once you reach more than 4 or 5 months, you become an investor because you simply just leave the stock there, right? So understand that investment portfolio, long-term portfolio, and your trading account are totally different. Never ever mix those two, okay? But what we did is we create a couple variables, this data, and I will show you guys how you can download from Yahoo Finance, and you create a return, calculate a return, and then categorize the year, month, and then the sign, so you know the return whether it's positive or negative, and you can also categorize them into decades. You can also map them out as election, and also you can map them out as recession. So this one, I'm gonna leave you guys to do it, okay? So if you have questions, you wanna show me your results, then by all means contact me, okay, by email, and then also schedule office hour with me. If you are committed to really be good at this, if you committed to really understand and learn more, I'm always here to support you, okay? So that one, I'll leave you guys to do that. So once you've done this, you effectively created what I call the data analysis for the monthly return, where you have so many different risk variables, right, to do this. And also, the thing is, guys, so far I include the election, and I said you guys can do recession. What other factors can we include? Well, there are so many factors we can include, yes or no, right? So once you include all the factors, and then this is just one stock, can we use this to analyze the stock market? Can we use this to analyze a specific sector of the market? Yes or no, guys, instead of just one stock?
Yes.
Yeah, so basically you can just download, for example, you can download the, just go to an ETF, for example, S&P 500. You don't really need to track S&P 500 index, just download the data for SPY. Just download data for SPY, okay? So I will show you guys how simple it is once you created this model, how simple it is for you to use the same thing without creating all these charts anymore. But before I show you guys that, okay, just understand, this is the average return by month, okay? This gives you a filter to analyze specific scenarios, so you know what to do, you're prepared. So you're not just hoping, I want to make 10%, okay? I like Apple, I believe Apple. The market does not care, okay? So, but if you understand the historical performance of this, then you will have a much, much, much higher chance. So for example, if it's election year, for September, I know most likely it will drop, but still the standard deviation is very high, right? So what I'm gonna do is I can actually have both positions. I can have long and short, but I would put more money on the short side, okay? And at the same time, I know September and then October is volatile, but after that, so these 2 months, when it drops, it's time to get in and then wait and then hold for another 2 months or 3 months, right? Even wait until, because the thing is, why is it even election year, right? The February, March, and April is going to be positive. It's because Apple is going to report the earning of this quarter, of the fourth quarter, calendar quarter, right here. And the fourth quarter, remember guys, that's the quarter that the company has the highest sales because it's the holiday season. It is exactly the same for any type of consumer product, okay? So understand that. This is what we call seasonality. Okay, that's why you see this kind of stuff exists, right? So you want to analyze the return and also the risk, so know what is likely you're gonna get. Okay, so now what are we gonna do? We're gonna do it one step further, what I call one step further, okay? And then that would be it for today's live demonstration, okay? Because there's so many other fancy stuff I can do, but if I go on to do that, I think most of you will probably feel overloaded. So we're gonna do one more thing right here. Come down here, copy and paste. So I have another table. So let's select all. Okay, let's analyze general. So what I'm gonna do right here is I'm going to put the sign down here. One moment, guys. I'm gonna put down the sign down here. Okay, you guys see that? So now I have the sign. So this is very, very interesting now. Okay. See that? So this is the average negative return of January when it's negative. And this is the average positive return when it's positive. You guys see that? Okay, so now it's a little bit different. So let me move this chart to the right hand side of this sheet so I can create more chart here. Now I'm gonna do this, copy this table, right, to this area. One moment, guys, let me do that again. Okay, let me quit. All right, perfect. Let me copy this table and then paste it right here. Good, now I have this one. And then what I'm gonna do is just like what we did before, I'm gonna summarize this by standard deviation. Okay, now you have the standard deviation right here. You guys see that? So standard deviation risk is always gonna be positive, right? Because it's the square root of the variance. And the variance, as we, what we learned from the risk and return analysis, the variance is the probability weighted square the deviation of the stock return from the mean. Okay, so now I have the positive and the negative, and I'm going to do the account. Okay, do the count here. So right here, so we can see, summarize the value by count, and then change this to numbers, and then do that. So you guys see that? In total, we have 418 months because that's 40 years of data, okay? 40 years of data. And out of 40 years of data where we have 480 months, I have 266 months that gives me a positive return, okay? Gives me a positive return. And I have about 209 months gives me a negative return. And here, the grand total right here is the weighted average, okay? So let me show you what it means. So if I do the negative and then positive, okay? And then this is what I call the weighted average return. And this negative is going to be right here, okay? Like that. And let me change this to percentage. Let me actually move this to the right. Again, I'm trying to create a table. So this is a table like this. This is not a pivot table because you don't want to work this pivot table. You cannot really manipulate data. You want to create your own table display, whatever you want to display. Okay. So I'm going to copy the calendar month right here. Okay. So let me move the table to this place a little bit. So now this is -8 and the positive return is right here. Let me link it to the positive return. Okay. Right here. And I'm going to change this month to the input right here. Okay, so this is makes it dynamic. And the positive return, let me change it in percentage. Okay. Again, I'm going to change the month to this one. Okay. So now I drag this down, I automatically have all these, okay, numbers right here. So if I change, for example, if I change the selection right here, let me make this a little bit smaller so you guys can see this table. If I change the decades right here and I remove 80, 90, and 10, 80 and 90 in the blank, you guys see that the numbers right here are the same, okay? All right. So this is the table where we have a display, dynamic display of the average return when it's positive, and average return when it's negative. And now I'm going to calculate the weighted average, okay? So the weighted average is going to be the percentage, right? So now I want to calculate the percentage. This is also very simple. So let me create another table right here, okay? I'm going to click it and then create it down here because simply there's some more, or let me do this, guys. It's actually easier for you guys to see. Let me copy and paste it and put it down right here. This does not change it. And then let me actually cut and paste this down back to here, or just a little bit down so it matches, okay? And then now I'm gonna do the same table right here. So what I'm gonna do, I'm gonna copy and paste this table. But this is gonna be the percentage, okay? So this is actually gonna be the probability, negative and positive. So let me remove that. And the negative equals 17 divided by 40, okay? Because 40 is the total. And this positive equals 21 divided by 40, okay? So let me change the month to right here. And then change this also 1 into this month. Again, you need to watch. So some of you who don't know how to use a pivot table, who haven't attended the Excel class, you got to watch this multiple times so you can understand this function. Once you understand, this is going to make you any dashboard that you want to make, and it becomes very dynamic, okay? So this is the positive and negative. You guys see that? Okay, so now I drag this down. You see that oh, one moment, guys. Let me make sure, okay? So I haven't changed this one yet. Here, this month is like that. Let me do that again. This equals this divided by the total. There you go. And I just need to change this month from 1 to the input right here. Okay, and then drag this down. Okay, now it's good. So the weighted average return equals the negative average return multiplied by the probability. Remember the weighted average return plus the average return of the positive multiplied by the probability of the positive. This gives you right here. Okay. .43%, and then drag this down, and there you go, you get this number. So now I want to show you guys this chart. So what are we gonna do is we're gonna create this. You select these two and create a chart like that, and select this one. Okay, and if you don't like this one, we can actually select this one. Okay, let me do, insert the chart. Maybe we'll do this one. Okay, this is perfect. Okay, and let me change the chart type to this to be consistent. Okay, so this is the Apple average monthly return scenario, my return analysis. Okay, and we're gonna create this one, and this is gonna be very interesting, guys. Oh, by the way, so you should select the data. For example, select the data and make sure you select the horizontal axis to be the month, so people know actually it's from January to December. Okay, right here. And let me do the same for these two. Select the positive and negative and create a chart, and we're almost done. Okay. Again, I'm gonna select this one. Okay, so this will add up to almost 100%, right? But you will see sometimes it's not 100%, and I'll explain you why, to you guys why. Okay, so this is the probability distribution. Okay, so we call it AP monthly return probability distribution. Okay, and of course you can enlarge the chart, right? One moment. Let me add a label to the chart so you guys can see. And also the color can be changed, okay? And understand the positive is gonna be, so usually on the stock market, the color, and let me add this too, the color is going to be green, right? So let's actually change it to green. So format the data series and then go to the color, right? Right here, fill, and then choose solid fill, and then use green because it's supposed to be green. So let me choose that. One moment, guys. I actually need to move this. One moment. So it's green. And in this one, I want to choose solid field. It's red. How many of you still with me, guys? I'm just really focused on creating a chart so I can explain to you. Type yes if you're still with me.
Still here, cool. Man.
Okay. Again, type in the chat room, don't talk so I don't record your voice, okay? After recording, you can start talking. Let me add data label right here. Okay, actually, one moment. All of it. Okay, let me delete this first. I did it. Okay, right, there you go. Again, format, solid, and let's do green. And then here, let's do red. Okay. All right, guys. So let me close this out. So here we have these two charts, right? Besides what we created right here. So this, you can make it smaller. And again, so the ideally, right? So this is what I call a half-baked product, So what you want to do is you actually want to, let me move this thing to this side, okay? There you go. So you want to move these charts to a different sheet, so you only see the charts. So you can manipulate the pivot tables to generate this chart. So what does this tell you? This tells you in September, for example, right? When there is also a chance of having a positive return, but what is the chance of positive return happening for the past 40 years? There's only 40% chance. So now we're talking probabilities, right? So for example, October, when there's a positive return, okay, when it's positive, the average return is actually 10.34% just in that 1 month, okay? November, same. And then in October, you have 72.5% chance of getting a positive return, and the average is 10.34%. How many of you feel good about that? If you feel good about that, type in the chat room. Okay, so this is one I'm giving you guys an example. Like when you do the data analysis, now you know when you bet on something, what is your odd? Like even if you don't understand, if you don't know what Apple does, you just know it's a good company. It has a sustainable business models, and it's very mature, and then it has billions of dollars sales revenue. Just by looking at their historical patterns, and then you will feel comfortable, at least, right? For example, because your goal is to let's do trading one-on-one where you just buy, right? You hope that you can make more money by the capital gain, and of course, you know that, for example, in this case, that in May, understand this is from the past 40 years, okay? Of course. So for example, if I go back here, if I simply select, again, if I choose only election, you guys see that only election, you will see this is where it makes more interesting. But again, if you combine election with recession, you will see some wild numbers, guys. You will see some wild numbers, okay? So here, what does it tell you? When it's election year, you see that. So for the past 40 years, the election years, there got to be at least 10 years, right? So for that 10 years, you have for each month about 10 observations. August, you have 80% chance of making a positive return of 11.11%. And then when it's negative 20%, it's 0. You guys see that? So this is a good bet when election year. And you know election year in September, you see guys, you have 60% chance when it's election year, 60% chance of having negative return. And when it's negative return, your average, guys, average is negative 34.996. And of course, why is this number huge? Because you probably included some recession years. How many of you got that? If you got that, type in the chat room, right? Because now we only have this one filter that has the election. You guys see that? So I'm leaving that, guys, for you guys to create the table, which you can download from Google, just like this, a table. You can type, you can copy, type all the recession years categorized by like Wikipedia or Federal Reserve, right? Type all those years and then create another column says recession and just type recession. So now you have a small table like this for all the years and you type recession. Once you have done that, you go to monthly return and then create a recession variable just like election here and do a VLOOKUP just like this one, look up the year. So you will have recession or no. So once you have done this, you can go to your pivot table analysis and click on these pivot tables, right? And then go to the pivot table analysis and change the data source. Now you can include that one more column. So go to A from N, for example, right? So if I change N here, it will include that column, but I'm not going to do that, right? So because I don't have that column yet. But what this does is, of course, we just created something from scratch, right? What I just demonstrated to you guys. The next step, okay, for those of you who are going to practice this. By the way, how many of you actually interested in create this on your own for the stock that you have or you want to get in, not Apple? Okay, just do it just for fun. Yeah. Okay. So let me know, because I'll be very interested. And like I said, you won't get this kind of training anywhere in the in the typical investment class from textbook. Okay. So I want to point that out. Okay. This is a half-baked product. So when I created a very complex dashboard before, when I was working as internal consultant for some agencies, right? This would become something that you put in a separate sheet. Okay, for example, perception. Let me just make sure you guys understand how to move that. So I can select this chart, and then this chart, and this chart, and this chart. Okay, I basically press the control, and if you use Mac, you just press the command key and then select all these charts, and you do a cut. So which is the control plus X. So now it's disappear. You go to this sheet and then just do a paste. So now on this brand new sheet right here, you don't see any pivot tables. You guys see that? You only see the results of this analysis. And this is similar with what you're going to see when you go to your brokerage account and you have some pie chart, you have some bar chart showing this kind of statistics. And once you click some filters, click some the factors, and then its dynamics is going to change. And this is how they are making it. Okay, because you can do this in Excel, and then somebody can code this into the website so you can see it in the HTML interface, right? But what you can simply do without paying anybody any money by using the public available data, you can actually do this kind of analysis. Okay, so the next step, again, right? I teach this in the Excel course as well, but not really in depth like this, right? It's you can create more, for example, selections right here. For example, election, you're gonna create something right here, okay, right here. And you're gonna create something like this, like a button and drop down, where you will have these charts right next to your, what you call your manual, right? Where your control manual, and you're gonna select the drop down list so that you can actually do manipulations and then see the chart move right here. Instead of going back to this pivot table analysis and then trying to do all these manipulations like manually, right? Then you can simply go to this, what I call the finished product. In this case, you only have the bar chart, right? But you can actually have a pie chart. You can actually have a more, let's say, the Sharpe ratio analysis for each month, and also the predicted portfolio or predicted trading returns analysis based on the average return, the probability distribution. So you will have a projected return if you get in. For example, if you get in at this time, if you get out this time, all that's going to be shown to you right here. So this is something that you can accomplish once you have built a model. You do not need to do this ever again. So what about, let's say you have new data? Well, just download new data. You just add incrementally, additionally to the raw data you have right here, right? So here's the thing. Here's the last one I want to show you guys. Okay, I want to show you guys. Now we created this for Apple, correct? For Apple. Okay. So now what are we going to do is we are going to go to Chrome right here. So now I'm going to search for SPY. Okay. So SPY is the most popular ETF for S&P 500. Okay. So this is like a mini version of S&P 500. So I'm going to go to historical data and select max. And this has a little bit shorter span because it's an ETF. Okay. It's only from 1993. And I'm going to use the monthly data. Okay. Apply. Make sure you click apply and download. Okay. So I'm going to open up this data now, and no worries, you are going to see this pretty soon. So now let me go back to the spreadsheet we just worked on. Okay. Okay, one moment, guys, right here. So you're seeing this. So I'm going to simply copy and paste. Okay, and you will see the magic happen. I'm actually copying the data right now. Copy, And I'm going back here to do the monthly return right here, and I'm going to copy and paste this right here. See, I paste it, okay? And I'm going to find out where it ends. One moment. And then I'm going to delete the rest of the data because it does not have that much as Apple. Okay, I'm going to delete it. Of course, you want to do this. You want to save another version, right? So because you don't want to overwrite what you have already done for Apple, but what you can do is you can save this as another file, which you already have the results from Apple, and then you delete this, right? So now this is just S&P 500, SPY. Right? But you still have the calculation here because you just basically what I call refresh the data manually. There's also automatic way for you to do it, but for most of you, this manual way is the best way to do it, okay? Because you don't need any subscription to any database. So now you go to this analysis, okay? What you simply do is you click on right click and click on refresh, okay? Refresh and refresh. That's all you need to do. You guys see that the data is now is less, and then you go to this. You guys see the change right now? If you see the change, type yes. Okay, so of course you got to change the name. This is what I mean. You save this once you create this for Apple. You save the file to another name, so you have the results for Apple, right? But then you use the same shell. You import the data you want for stocks or ETFs or your portfolio data, right? Historical performance of any portfolio that you want to invest, right? You can get the mutual funds historical performance data, right? Like monthly and the daily return, weekly return. And this is going to show your odds, right? So for example, S&P 500, you'll see that the SPY is a totally different scenario. And then if we go back, we know that we select the election. So we can actually select all cases, right? Just to make sure you know. Again, this is a half-baked product, so we're going back to the pivot table to select that, okay? But once you have built this a dynamic dashboard, you don't ever come back to the pivot table anymore, okay? So this we select all. Let's go back to sheet 5, and you will see the difference. You see that? So if you select all, you know that to invest in S&P 500 SPY, right? Of course, you got to change the name here, right? It's not Apple anymore, it's SPY, right? But you will see that the still is a little bit different. October, November, you have a higher return, and then for the rest of the month, especially during the summer. Remember what? How many of you heard this phrase, right? So Wall Street is you sell in May and then go away. How many of you have heard this? For people from Wall Street. So usually the summer is pretty boring, okay? Because most traders they sell, they get out of their position and they take a vacation during the summer, okay? So that's why you see that during the summer it's pretty boring. You guys see that these months, okay? It's almost like close to 0% return. The negative is also very, very small. So this is what you want to when you invest in S&P, SPY. You guys see that? It gives you 1.84% in November average, okay? And then 1.52 in October. Do you guys remember what the number for Apple is, right? It's close to 10%, okay? So 10% compared to 1%. That's when you buy the market versus you buy a specific stock, because the specific stock usually has higher volatility. Not all of them, okay? Some of them have less volatility in the market, but some of them has a higher volatility in the market, okay? So I'm just gonna do reverse all of that, okay? All right, so now we are going back to Apple. Let me make sure we have Apple. Okay, now we have Apple stocks, stock return. Yes, good. All right, so let me stop the recording now, and then we can have a discussion. One moment.